So with every strategy, you want to understand three things, I think. First is, when is it supposed to make money? When is it supposed to lose money? Long-term trend following is supposed to make money when the market goes up, right? When the market is choppy, going down, you're likely to lose money with that. If you run a back test and you've got a phenomenal, beautiful equity curve from left lower to right upper 45-degree angle, and it's long only, you know that something is off. If things look too good to be true, they are.
Probably are.
Yeah, but the other thing is, it's the hidden risk. It's the thing that you don't see in the results of your strategy that could possibly happen.
Welcome to the Algorithmic Advantage. We're here to expand the toolkit of the quant trading community and introduce investors to the many advantages of systematic trading. Our goal is to educate and inspire as we embark on a captivating journey into the vast knowledge and experience of leading portfolio managers and other experts in the field. We hope you enjoy the show, and if you do, please subscribe, leave us a review, or even buy us a coffee via the link on the algorithmicadvantage.com. We really appreciate it.
Before we begin, can I quickly remind you that if you're not jumping on our website, you're missing out. Over at thealgorithmicadvantage.com, of course, you'll find a tools page where we share our data and technology stack we ourselves use, as well as our blog with a bunch of interesting technical articles. And hey, if you're not yet a subscriber on YouTube, then please hit the like and subscribe buttons. We really appreciate that. If you've got questions or feedback, good or bad, please just send us an email to info@thealgorithmicadvantage.com. Now, on to the show. And of course, as always, I'm joined by my esteemed co-host, Richard Brennan. Welcome, Rich. How are you doing? And why not welcome our guest to the show?
Will do, Simon. And welcome to everybody. It's getting to be spring over here in Australia, so we're appreciating the warmer weather. But enough about the weather. Today, we've got a very experienced trader, author, and trading mentor, who's also a good friend and collaborator with Tom Basso, who was recently on our show. He hails from the Netherlands and now resides in beautiful Portugal. A master of diversification, trading over 50 strategies. Lawrence Bensdorp, welcome to the show. And how is a beautiful Portuguese summer going?
First of all, thank you for that wonderful intro. That was outstanding. Thank you. And yeah, it's wonderful over here in Portugal. It's nice weather. We're in the middle of the summer still, and it's a great place to be here right now. Absolutely.
Well, Lawrence, as is our usual custom for people like yourself who have been on a few shows before, we will dispense with much of the history, as people can go and find that elsewhere. They can read your books, and they probably know you already.
Yep.
So I've been really looking forward to this one, as we've spoken before about the fact that I think we trade in a fairly similar fashion.
Right.
A lot of equity strategies, and a lot of different strategy types, and we try to diversify as much as possible. So keen to sort of dig into those things, I guess, maybe one at a time, because I know that you trade equities, I believe some ETFs, futures, you trade across mean reversion to trend following. So without jumping into it all at once, maybe we can start with your philosophy, like some of the key, the things that you find are most important in trading overall, part of your philosophy that shapes how you trade and why you trade what you trade.
So as far as my trading, the majority is definitely a main focus on equity. I do make a distinction between different styles and different directions. So I call those legs, basically. So I have one leg that trades a trend following long version. Then there is a trend following short version. And then we go to another style, which is the mean reversion style, where I also trade mean reversion long and mean reversion short. And so you've got the four legs, basically two different styles, two different directions. And for me, that is like the big base that I have. And from there on, I extend to have a lot more different strategies. The reason I like to have those different styles and to have those different directions is that I have more possibility to making money regardless of what the market does. There's a possibility to make money in sideways market with mean reversion strategies. Generally, the trend following strategies are not doing that well. There's a possibility to make money in bull markets for the long strategies, but also when we get bear markets, I have the short selling strategies. So that is the core that for me is incredibly important. I think, however, because I do trade equities, it is very important to diversify a lot amongst those different legs as well. First of all, because we have a thing called corporate risk. Corporate risk is that when you trade an individual stock and that stock closes at $20, so you bought it at the close, let's say $20, and the day after it opens at 10. That is something that generally with futures you wouldn't see that much extreme. But with stocks, and it certainly can happen a lot more. So you want to make sure that you do not have a large allocation of your money towards one single stock, but to diversify and having a lot of different strategies in order to get into different stocks. The other thing is, because I trade stocks, I do think that the future variability of return streams of those individual stock systems can be larger due to the nature of the corporate events, which sometimes can be in your favor, but could be against you as well. And that is another reason to say, like, okay, you want to diversify within those different legs. To say sometimes there is a type of a market where trend following systems that have a 200-day look back would do incredibly well, but where a shorter look back of, say, 25 days would not do very well. And if I combine those different return streams, what my observation is that I can have a possible higher risk-adjusted return, but also a more smoothing of the equity curve.
Absolutely. Right, fantastic. I love it. So 55 systems. So they break up into these various legs. Let's start with mean reversion, because I believe you started with mean reversion, and drill into that a little bit. So I guess, how many of those models are dedicated to mean reversion and long short, and what kind of mean reversion strategies do you trade over what kind of stock universe?
Let's split it up on the long and the short side. Personally, on the long side, I like to have as large as possible of a stock universe that I can have. So it's generally all listed and delisted stocks, but then you need to look for a liquidity filter and a price filter to make sure that there is at least is a little bit of liquidity in there so that you do not move the market as much Plus, I think if you trade on stocks that only have like an average volume of 10,000 shares, you're kind of in a universe where you don't really want to act. There's something weird going on over there. So you want to have enough liquidity in there. But I do want a large tradable universe on the long side, because as mean reversion strategies generally tend to have a very short holding period, and therefore the expectancy per trade is low. If you only have 9 trades per year on that low expectancy, it's not going to help you a lot to achieve a compounded annual growth rate that is worthwhile for you. So you need to have a good enough trade frequency for that. You also want to have some kind of filter in there that says there's enough volatility in those stocks. Again, because the trade duration is so short, like between 1 and 5 days maybe, if there's no volatility in the stock, if the stock on average moves up and down 0.2% per day, you're not going to have a lot that is going to help you to possibly get for a nice compounded annual growth rate.
So, Lawrence, do you normalize your treatment of stocks? In other words, normalize to their level of volatility so all stocks are treated equally?
I do, yes, but I also max them out as far as a percentage of my total equity. So it's a combination of volatility adjusted sizing, but because of the nature of stock, sometimes when you size your position and you have your stop loss very small and your position sizing is based according to your entry price and your stop loss, it could mean that you get a huge position as far as a percentage of your equity. And besides the fact that it could possibly get you into trouble with margin issues, I also think that to me personally, I like to adjust for volatility, but adjusting for volatility is looking at the past. But it's not to say that the future of that specific stock, that volatility stays the same. So that's why I say, okay, I just cap it to a certain percentage of my equity. So it's a combination of both.
And what about on the short side then? What's the difference there, Lawrence?
Yeah, the short side is a little bit different. I think, first of all, the objective of the short side of the strategy is a little bit different than on the long side. For me, the short selling strategies for mean reversion are really there to help me when the long trend following systems are starting to lose money, but they're still in a position, but they start to give money back. At that time, I need some help from another leg, which is the mean reversion short leg, that could basically, when there is a pullback to the upside, I could short that stock. And when it drops down, then those positions make money, while assuming that the market in a whole is very correlated, the trend following part would lose money. So it could offset very nicely. However, there is, with mean reversion short, an additional risk that you have an unlimited potential corporate event that can go against you, where you short a stock on $10 and the day after, potentially it could open up at $40. And no matter where your stop is, you will be stopped out at a terrible price. So the corporate risk there is a lot larger. I also want those stocks to be a little bit, I would say, more liquid and less of an irrational behavior. I don't want to be short like stocks like GameStop, for example.
I was just going to say that's a very real risk, isn't it? The meme stock event in January 2021.
Exactly, and it was, I think, everybody who was trading short mean reversion was probably caught in those stocks at that time, including myself. It wasn't a big deal for me because I was trading about 14 mean reversion short systems at that time already. So my allocation per individual stock was incredibly low. But still, I said, when I get a signal to short a stock that has been moving up over the last 2 days more than 100%, there's something else going on. There's something going on where I do not want to participate. So I want to filter those things out and to make sure that I am in stocks, first of all, that are shortable, but secondly, that are not acting that crazy. I do not want to trade, for example, biotech stocks on the short side. I think biotech stocks generally are the stocks that have the most risk for a corporate event. After the market closes, there suddenly comes a news message out that a patent of a certain company is approved, and the day after it skyrockets or it's got bought out or stuff like that. So I don't want that in my portfolio at all. Even when it tests better sometimes, I don't want them in there because I've seen that in the past as well, that you sometimes get hammered with those stocks. I love them on the long side, totally fine, because I know that my worst case scenario is that they go to zero. But if I short them, I don't know what my worst case scenario is. I'm not a fan either myself of shorting energy stocks, and I don't think there is necessarily anything wrong with shorting energy stocks. But for me, the objective is that they need to help the non-performance of the long systems. And I think the energy sector is a sector that generally is less correlated to the overall stock market. So I don't want to have a scenario where I short a stock, the market goes down, but that specific sector is actually moving up. So I get from both sides, I get the worst possible outcome. So I think those are probably the main differences.
So, Lawrence, your small bets obviously is probably your ultimate defensive weapon here for risk events, but also the way your legs work together to offset each other. So with your mean reversion strategies, are you ensuring that your trend following strategies are working on the same markets as your mean reversion strategy to provide that offset?
No, I don't. I prefer myself to trade trend following more on S&P 500 stocks, NASDAQ 100 stocks. I think there's an inbuilt survivorship bias in those indices. I mean, the stronger stocks get added to the S&P 500, and generally the weaker stocks get kicked out. I used to actually do what you just said, to trade trend following on all stocks, but that is one of the approaches that for the last 3 years or so I have changed and said I only want to be trading indices. But I could trade, for example, as well, a basket of energy stocks. That is fine to me. But I do have a large emphasis on the main indices.
Before we get too far into trend following, because we will go there, and I realize everything is related, but we've started discussing a really important topic, which is risk management in mean reversion, right? It's critical with mean reversion trading. We're trading negative skew strategies that can have some serious black swan blow up risk potential.
Yeah.
So one thing I wanted to pick up on there is, trading 14 short strategies and therefore having these small bet size. The assumption there is obviously that those strategies are not trading the same stocks. So am I right that you would separate out universes for those in order to guarantee that you're trading very small positions in individual names?
That's one way to do it. I think I'm okay on the long side to have like a double or a triple position, because if you trade so many different systems on the long side, I'm a little bit more comfortable to have a little bit more on as far as the risk. But I think separating the universes completely, it's getting very hard then to create good strategies. I think what is a lot more important is that you really focus on first of all, on your entry parameters, that they are significantly different. So every new strategy that I develop needs to have a belief and an objective that is very different. If I see in strategy one that I use a system that has a very strong pullback, then I want to use in system number two a different kind of pullback. To make sure that I do everything possible to make the strategy conceptually different as well. Now, if there comes then a signal that I already have in my portfolio or a double signal, and I don't want to trade that, my software then says, okay, I can only trade of that strategy, I can trade 10 stocks. So that 10th stock I could not trade because it is in strategy one already. So let's look at candidate number 11 or number 12. And generally, because I trade such a large universe of stocks, often you get like 150 setups, but my money management says I can only trade 10 stocks. So it's very easy then to say, okay, I go to number 11.
Yeah, absolutely.
But the core is to make sure that your entries and your rankings are fundamentally different as far as the belief and as far as the metric. If you then enter into the same stock, that's fine for the long side. For me, on the short side, not, absolutely not. But then you want to make sure that you diversify at least on your exits so that every mean reversion strategy, every exit is different. And it's above all, I use quite often time-based exits. So I say after 3 days, if the stock hasn't reverted to its mean, I get out. Because I want to look for another candidate then. But if, let's say I have 10 strategies that all have a 3-day time-based exit, what I do then is I place my bets on that all those strategies within 3 days will revert to its mean. But some stocks within a day revert to its mean already. Some need 5 days to revert to its mean. Others will never revert to its mean, but at least I want to do as much as possible to spread that out as much as I can.
So effectively, Lawrence, you're approaching this like an engineer, in that what you're doing with your systems is you are forcing uncorrelated properties into your portfolio through your designs.
Yes.
So you're not replicating designs. You're making sure that entries, exits are all diversified, holding periods are all diversified, strategy type is all diversified. So you don't really then have to worry about correlated markets, because your trade results are uncorrelated by virtue of your system design specifications you're integrating into that portfolio.
Absolutely, yes. And as far as correlated markets, as far as my equity trading is, I am prepared for the fact that the market is 100% correlated.
Yeah.
That is not always the case, of course.
Important.
But when you most need that non-correlation or that diversification, is not there. We all have seen that when the market sold off during COVID, for example, 95% of all the stocks, boom, just went down like that. So that is an assumption that I want to have, that when the market goes down, my assumption is all long systems will lose money. I cannot have the assumption that a long system makes money when the market drops.
Yeah.
Although you see that in test results.
Yes, the overfit test results.
Well, yes, but sometimes also you can see it in, for example, I traded mean reversion long already live in 2008, the bear market. So I traded at that time 2 mean reversion long and 2 mean reversion short. That was all that I was trading. And they both did phenomenal. So at that time, after the 2008 debacle, which was one of my best years, I had the false belief that mean reversion long makes money in a bear market.
Okay.
That always catches up, of course, and I got my lesson then in 2011 in August.
2011, I was going to say, yep.
Yeah, it's a classic one. And then I saw that everything just kept dropping, and I said, okay, it's not like that. So having that assumption is, I think, a very useful one.
Yeah.
And not relying on, well, I've got those back tests, and there's a huge bear market, but this long system makes money, so this is non-correlated. No, that's just either overfitted or luck.
Yeah.
There's not a lot of mean reversion traders who might have done a back test over the Great Depression, or which you probably would struggle to do, or 1987, Black Monday. That's an extreme correlation event as well, isn't it?
100%, yes. And if you just look at those market events, you have to assume that all your mean reversion long systems who were in a position would have lost money. Maybe a couple you would have bought them at exactly the right time, but you want to assume that it's all losing at that time. And yeah, as far as the data, if you take a look at 87, you take a look at 29, mean reversion systems are not really testable during that time because commissions were completely different. The pricing system was different for the stock market. Stocks were priced at $30 and 1/16 and stuff like that.
Fractions.
It's a whole different thing. But the assumption stays the same that, you will lose money.
You have to be prepared for the worst. And what about regime switches, Lawrence? Like, do you incorporate an awareness of whether you're in a bull market or a bear market? Would that change the strategies you're trading or how your strategies trade?
And do you refer to mean reversion now?
Yeah, let's stay with mean reversion.
So on the long side, I do like to have a trend filter for the stock in there. So the stock needs to be in an uptrend. That can be a longer term trend sometimes, like let's say a 150-day exponential moving average or so. I do have strategies as well that some of them have a market filter where it says the S&P 500 needs to be above the 40-day moving average. And the reason I have those is not necessarily because they perform better as a single system, but when you get a market that starts to drop very fast, I assume that all my long stuff will lose money. Now, I won't have any new entries for that mean reversion system if rule number one is if the close is below that 40-day moving average, I'm not getting into any new trades. So that helps me basically by automatically lowering my possible exposure on the long side when the market is not in my favor. Also, when the market then starts to react again to the upside, you then get earlier signals actually to be trading when the longer term trend filters would still not generate any signals. So that is as far as I go with market regimes about that. On the short side, I generally don't. Again, that has a specific reason, because I want to help the non-performance of the trend following long systems. And that's the main reason for it.
I've got two last risk questions pertaining to mean reversion that I have to ask. One, of course, is stops. Traditionally, the argument is that stops are unhelpful in mean reversion systems. Do you choose to use stops or not? I mean, you use your time stops.
Yeah, but right. I always have a stop loss. Does it test better? I've seen a lot of reports about that it tests better. I think if you start a back test without a stop loss and you find 4,000 trades that look very nice without that stop loss, and you then add the stop loss, it looks terrible, most likely, which says something already about the procedure that you most likely did about the back test of not using the stop. But I couldn't trade without a stop. Even if the assumption would be correct that stops hurt, and there's a good case for that, but it is still risk management. And I, as a trader, I like to think a lot in worst case contingencies. What happens if I buy this stock at $20 and over the next 5 days, every day it drops, and it never reverts to its mean, and eventually I need to close it out at $1. Well, if I have a stop of, let's say, 20%, I can get out at a loss, but it's not a big loss. So you want to have your stops most likely wide enough on your mean reversion system so that it is designed that it is not going to be stopped out, but it is more of an emergency stop loss. But I do size my positions according to where my stop loss is. So I will lose X% of my equity when my exit price is the same as my stop loss price.
It's interesting, Lawrence. What you're saying, if I'm hearing this correctly, is that you're not selecting strategies by virtue of their individual performance. What you are doing is you are selecting strategies by virtue of their beneficial increase to the portfolio result. So by putting stops in place, yes, you might be going against the mantra that stops deteriorate your performance, but from a risk management perspective, you're integrating essential risk management perspectives to give the portfolio protection. So I'm seeing this as a case of you're less concerned with choosing the winners or the optimal results, but more how do I package this to be the most robust portfolio available, but you've got sufficient power in that portfolio to benefit from any beneficial volatility. You're always looking to cap your adverse volatility and your drawdown. Would that be a way to say it?
Perfect. Yeah, very, very well said. I just want to make sure that I am covered for any kind of worst case scenario. I don't care if I have strategies that are 75% of the times correct, which you could easily get when you don't have a stop loss. I'd rather have them 60% of the times correct, but therefore I can sleep well. That to me is so much more important. And I also think that sooner or later, you're going to be hit so hard if you don't have stops. There will come that day, I call that the man with the hammer. I used to get that man with the hammer when I was young and I had too much alcohol. Now the man with the hammer to me would be when you look at your daily trading performance or your weekly trading performance and it feels like you got hit with a hammer, like the market is out there to get you, and everything you had just basically moved against you. And if you don't have any stops and the assumption that the market is very correlated and you get a huge sell-off like COVID, my goodness, that would not be fun then, because it was going momentum down like that. There wasn't any kind of reverting to the mean for quite a while.
Yeah.
Lorenz, how did you go in 2022? A lot of us struggled with mean reversion strategies in 2022 specifically. It was quite an anomaly on the map so far. And how did you go and what have you learned from that?
Accepting that when there is a market that is not that volatile, but is still a bear market, but it was a lower volatile bear market than usual. So to me, they didn't do too bad, but I wasn't pleased with it. Neither was I with my trend following short systems. They were okayish, but it was kind of a weird market environment. And I looked at it and I said, like, okay, is there anything that I could have done differently? Would there be any additional strategies that I could have added? Yes, in hindsight there is, but for me it was more of an acceptance like of a very boring year. I was positive for the year because I trade long and short, of course. But the mean reversion systems, they need volatility. There wasn't that much going on for me. So yeah, and then I think it's important as well as a trader that you accept sometimes a year of a non-performance, and then accepting for the fact that that doesn't mean that your strategies are broken or anything. To me, everything looked totally fine, and Rich can talk definitely about that as a trend follower on commodities. You know that you need to accept those times where you are in yearly long drawdowns, but you believe in your strategies and you're able to sit that out. Is it fun? No, not really. But I haven't found anything or any specific style for mean reversion that consistently would do incredibly well in 2022. Not like 2008, for example. Have you seen anything else with that?
I found it very tricky to analyze myself, to unpick exactly where the problems were coming from. I did feel like it was easy to blame Fed policy and grinding markets and lower volatility. And I found that I guess it was a lesson in staying with stronger stocks, stronger trending stocks, or higher
there
market
weren't a
cap
lot,
stocks.
of course, because of the market environment.
Yeah, so it was a tricky one, and like you, I think probably the two big takeaways were, one, you just need to always diversify more, and two, you need to accept that things take time to play out with any strategy, and you need to be prepared that it's not always going to be exactly as you dreamed it would be, and that's just part of the game.
Yeah, I think that's the most important part, because often we draw too fast a conclusion based on a recency bias, that, oh, it's not working, I need to change it. Sometimes it's just random behavior of your strategies that you need to accept. I try to diversify within that by having so many strategies. So when 4 or 5 strategies are behaving a little bit randomly, then possibly another few are behaving better if I have diversified enough. But to me, I think it was mostly that I just didn't get a lot of good trades, and but I couldn't find any reason to say, okay, I need to change something on my approach. Not really. No.
I think we've just got to accept that there are regimes. There are favourable trending regimes. There are favourable mean reverting regimes, and there are unfavourable noisy regimes where both mean reverters and trend followers have a tough time. And I think that they're just a symptom of the nature of these markets and will be ever so. So I don't think we can ever expect this constant performance. We've got to be prepared for a degree of volatility in our performance.
Yeah, if you look for perfection, most people look at it at the wrong way. To me, perfection is executing your suite of non-correlated systems 100% all the time. That to me is as perfect as it can get, as long as the design of it is correct, of course. But the perfection is also understanding that when you have a year where it doesn't work that well, the acceptance that is part of the deal. But for example, my long commodities part on the trend following side, the first half of 2022 was fairly decent.
It's part of the fun of trading. It's the unsolvable problem too, right? So we're always hooked. We're always trying to work out the next move. We're always trying to solve the problem that we had last year, and that's why we love it so much, because we love analyzing it and believing that we can somehow win. But there's just really so many variables in the machine, and that's why it does come back to this simplicity and diversification.
The cornerstone's risk management, I think, Simon. I think we've all worked that out.
We have.
If we can mitigate our risk, manage our risk, the opportunities naturally come. The key is survivability, being in the game for the long term, which means stringent risk management. Your design of your strategies are so incredibly important for that purpose of risk mitigation and how they all work as a portfolio. So, yeah.
Yeah, and I mean, it reminds me a little bit of my personal trading in 2019, where my trading, I wasn't trading 55 strategies, but around 30 strategies at that time. And in 2019, it wasn't really going anywhere. And it was a time period where the stock markets were doing very well. S&P 500 was up 28%, NASDAQ even a little bit more. For some reason, my stuff was not performing. And then you look at it and you say, so you do a lot of analysis then. I mean, we always do the most analysis when it's not working out, right? When it's working out and we're up 40% for the year, we feel like the king of the world, and it's all great, and we crack the code. Yeah. And that, of course, always comes back to you later then. But I couldn't really find anything, even with strategies that weren't performing for 2 or 3 years. I said, well, they still are conceptually correct. Yes, they had a random period of worse performance, but that is going to happen to every strategy, and that's why I advocate so much of having a lot of different return streams, so you diminish that risk of one strategy that performs badly having a very large impact of your total equity. So then came 2020. suddenly a complete different market environment. It can't be more different
You
than
sound like a
290.
trend follower, Lawrence. I think 15 was hard, 16 was even harder, 17 was awful, 18 was criminal, and then 19 still bad, and then 20 blue sky, sun shining,
Yeah.
bliss. It
And
was amazing.
as you trend follower, you probably had a larger compounded annual growth rate than I had. But it was a very, very comfortable year for me as well, both on the downside and the upside. There was more volatility. And those strategies that for 3 years didn't perform, they were the best ever. And that gave me, of course, even more of a confidence to say, like, don't touch it.
Yeah. I think volatility came into the markets in 220, and my gut feel tells me that the stance changed from quantitative easing to quantitative tightening, and we suddenly got this release, this massive release of this pent-up volatility that was lurking there in the markets, and suddenly it exploded in 2020. So yeah.
Crazy times there, with crude oil going negative and stuff like that.
Yeah.
It was insane.
One thing I like about what you've said there, Lawrence, in terms of having the confidence to weather a storm for a while in your strategies, is it comes from having that logic-based, principle-based approach. You know there's a logical reason for what you're doing and why you're trading this way. It's not just a black box that the machine spat out. So you can look at it and logically assess it, and that helps you retain some confidence. I think that's really important.
Yep, absolutely.
I wanted to quickly ask you whether all or the majority of your mean reversion systems were essentially catching falling knives on the way down in terms of placing limit orders into the market, or do you have some or all of your strategies that would say, execute on the open, or execute maybe after a bit of a bottoming process or anything like that?
I do have strategies like that, but I do not label them as mean reversion. That would be another lag, basically. And one could call that, for example, a blend, where you have a trend, you have a pullback, then you have a resumption to the trend, then you get in, you have your stop loss fairly small to the lower part of the previous pullback, and then you have you just let it trail, basically, or you have a little bit of a larger profit target of, let's say, 15% or something. So I don't think that is core mean reversion, because you're measuring a trend, it pulls back from the trend, but then it resumes the trend. So it gives you evidence that the trend is still intact, and you just have a good way of buying it a little bit cheaper. And that, to me, is a different kind of lag. It's not a core mean reversion lag.
Bit of a
so
hybrid.
Mean reversion lag.
We'd include that in our trend following as a sort of like a retracement entry into trend technique. Yeah.
Right. So it is just whatever the label that you give to it. I think it has a component of mean reversion in there, and it has a trend component in there, and that's why I call it a blend. But it's
a hybrid.
Yeah, a hybrid as well, exactly. But eventually the trend following person would call that a trend strategy. The mean reversion person might call it a mean reversion strategy with a different twist on it. It's just whatever the label you give to it. But it helps you, again, to have opportunity to make markets in a different environment, because most or often when you get in a trade like that, your core mean reversion systems are getting out at that time, because you had that beginning reverting to its mean already of your core mean reversion strategies. So that those would be flat, and that means that you don't have any chance to continue to compound. So if you then have that hybrid in there, then you can continue to compound.
Do you do any mean reversion trading on ETFs?
No.
No.
I don't see the upside in there versus mean reversion for stocks. And there could be a case for trading them on the short side, for example, but I'd rather short S&P 100 stocks, S&P 500 stocks, and stuff like that. Not really, no.
Okay. I want to let Rich ask you about trend following, but go for it.
I was going to say, does Tom Basso view as a heretic with all of these mean reverting systems?
A heretic? What's that?
I assume Tom's very much the trend follower. So how does have you sold him on the need to integrate some mean reverting into his models?
I think so.
A trend follower will always be a trend follower, but he visited me back in, I don't know, I think it was 2018 or something. I can't remember exactly. He visited me in Spain, and just as friends. But we then decided, okay, let's spend a couple of hours in my office and compare each other's strategies. And we kind of knew it already a little bit, but I thought it would be fun. And it turned out that we felt like two little kids in a sandbox that definitely didn't want to go home because it was so incredibly entertaining to discuss and to see each other's stuff and to learn from it. It definitely helped me to implement more trend following. And I think Tom did some kind of mean reversion, but exactly what we just spoke about, that it still needs to have that trend component in there that it reverts to. I mean, Tom would never buy a falling knife in an uptrend. No way. No. He couldn't. Yeah.
So, Lawrence, can you explain some of the trend following strategies now that you have in your portfolio?
Yeah, of course. They're very simple in nature. Very simple. I think that is the key as well. So a simple system would be a NASDAQ 100 system where we say the close of the NASDAQ 100 index is above the 200 daily moving average. The close of the stock is above the 50-day Keltner channel plus 2 average true range. Then we get a certain amount. So that's the whole trend component. That's everything. Then we get, I don't know, maybe 20 or 30 candidates. And then I would say I would rank them by the highest rate of change over the last 200 days, which means that they're volatile, which means that they were most likely trending up over the last 200 days. And then place a stop loss of 15% and trail it with 25%.
Okay, so this is like a cross-sectional technique we often hear about in trend following. So in the equities universe, which is very vast, you've got to use some form of selection process. So what you're doing is you're saying, I'm using a primary filter, say, of the index itself, like NASDAQ, and then what I'm doing is I'm then ranking all of my stocks and taking the top 30 by rate of change, and you're going long, or do you also go short? Are you both long and short for your trends?
Stocks, trend following, only long.
Okay.
Again, if you're shorting stocks for the longer term, you have that corporate risk continuously being present for a longer time. So there, I think shorting ETFs has not have that corporate risk. Okay. But I think where you're aiming for is that selection of the ranking as well, right?
Yes. Yeah.
And that is a very important part because often you find in testing that a certain ranking does better than another ranking. So let's say in the example that I gave over here that the 200-day rate of change does very well, and it does actually. If, however, you then start to develop your next system, you want to have a ranking method, anything but the highest
200.
rate of change over the last 200 days, even if it tests worse.
Okay.
So
yes.
I call that a non-correlation matrix, and it's a fancy word for a spreadsheet where I put in all my parameters of my strategies, and my students need to do that as well. And it makes it a lot easier, actually, because when you have system A that has ranking of highest rate of change over the last 200 days, well, you know already that that is not a parameter that you can use for your next strategy, period. Because otherwise, you start to look for the same thing over and over again, and you use the past data with the assumption that the best possible ranking will be the best possible ranking in the future as well, which we know is often not the case.
So you once again, you're integrating diversification of strategy type into trend following with your different rate of changes being applied for your models. So once
not only different rate of changes, sir, it could be any kind of measurement. It's definitely not like
something offers co-integrated benefits. So they're definitely different.
Yeah, I mean, like highest 14-day RSI, for example, as a ranking. That, to me, I'd say that would be fundamentally different than a highest rate of change over the last 200 days.
So that gets you into your stocks. Do you then apply that method of selection as a way to get out of stocks, or are you applying a trailing stop behind your stocks once you've entered?
Generally, just a trailing stop, and sometimes a trailing stop could be a 25% trailing stop. I also don't want to have all my strategies win a 20 or 25% trailing stop. So you could also have a simple exit rule like a 200-day Bollinger Band or a Keltner channel or a Donchian channel or something that says it's going down. Okay. So get out.
Okay. So potentially you can be in for the long haul if you're onto an outlier. Your systems are going to stick with that. So. They're not necessarily going to get out too early, and so you'll be riding them.
Yeah, that's what I hope. I've tried a lot with very short-term trend following, and I do have systems like that where they enter on a 20-day look back, for example, a 20-day Keltner channel or something like that, and they get out earlier. It took me a while to accept the fact that they do not test that well in my sample size.
Yep.
But once I overcame that bias of believing that the sample size is the holy grail, then I said, yes, I want to have this in because it gets in earlier and it gets out earlier, which is different. So when we get to a market environment like maybe the 1964 to 1982 period where we had 18 years of a flat performance of the S&P 500. There was a drawdown of 50%, but net there was no difference. Then at least I have my odds on some other strategies as well, and not only the strategies that did so well from 1995 to 2024, which is a biased bullish sample size, I would say.
Lawrence, do you trade any rotational systems?
I do, yes. And it's a good question, actually, because the reason I trade rotational strategies is that it brings me diversification in my exits. So a rotational strategy, the ranking basically defines what stock to enter, but also when to exit. So if we use the same example, highest rate of change, So you enter in a stock when it's in the top 10 of the highest rate of change, and you exit the stock, you rotate it out when it's not in the top 10 of the highest rate of change anymore. That doesn't say anything about that stock. It actually could still be making money and not even being in a downtrend, but maybe there is another stock that's even more favorable. So you rotate them out, and that gives a great diversification because you're not exiting because the stock goes down. And that diversification is there then because when the market drops, whether you have a 25% trailing stop, whether you have a 200-day Bollinger Band, a 100-day Keltner channel, they all get stopped out.
So the question is, that's one of your 55. Now the question is, how do you manage all of these 55 strategies?
Thank God there's automation.
Well, tell us a little bit about your technology stack since we've opened up that question, Lawrence. Tell us about your software that you use, your backtesting software, order management, how you manage all of this, and how automated is it?
So it's in-house built by an ex-student of mine, actually, nuclear scientist, super smart guy, and the software that I was using at that time was incredibly slow, or at least a lot slower than what we use now. So he came up with a prototype and said to me, like, Lawrence, I want to be in a call with you and show you what I built. And it was a prototype, but it was completely built to design as many non-correlated systems and being super fast as well. So built on C#, and it does all the backtesting. It is a drag and drop software, so there's no programming at all required. That was a requirement for me because I can't program. Awesome. I can't write a line of code. And I think there's pros and cons to that. So the hardcore programmer would say, well, it's always good if you can program, right?
Well,
that came
this
to
is the argument
mind.
Simon and I often have.
Now, let me give you my thought on it. I think that's true, but I think with coding, you get a lot into single system minded things. And what I like is the fact that you focus from the beginning on having a large suite of different systems that are all very simple. I don't believe in magical codes as far as a super indicator or stuff like that. If you measure a trend, and you guys know that if you use a Keltner or a Bollinger or stuff like that, it doesn't really matter. A trend is a trend. So I then say, well, I don't need to focus about any of the code because when something is wrong, then I need to read through all the code and find what's wrong with that. So with the assumption that everything in my software is hard-coded correctly, you can then basically select whatever parameter you want to, or multiple parameters. You can step those parameters. We get all the output as far as all the statistics and everything. And we have a button that's basically shows you exactly what orders to place for the next day on your broker platform. Now that part you could do automatically. I have other software for that does that part, you could do that manually, but I have software for that part that does it automatically as well, and it integrates with interactive brokers. So every day my workload is basically between 1 and 5 minutes for my 55 systems. I get a report from the software that tells me if everything was executed correctly, if there were any issues, if there weren't any short availability and stuff like that. And that is the only way that I could trade 55 strategies at the same time.
So with the trend following, Lawrence, do you trade some futures trend following strategies on futures?
I do. It's not a huge focus of mine, also because we haven't automated yet the execution. And I know myself, I travel a lot, so there is some margin of errors then that could happen if I travel and placing the orders and stuff like that. So there's some commodities, stuff like that, where you have a reasonably good ETF. So I do that on automation, but then I have some others that I do trade manually, but on a very long-term look back. So if I get one day later into the trade because I missed it for some reason or so, it normally shouldn't be a big deal. But end of the year, that part will also be completely automated as well.
Nice. And at the end of the year, what percentage of your trading would be on futures versus equities, do you think?
Around 30%. And if that would be trend following only.
Yeah. If we were to break up those 55 strategies then into the different categories, like how many pertain to mean reversion, how many pertain to trend, how many to momentum roughly?
I would say as far as the legs, it's fairly equal. But the individual legs, I have the most strategies on the mean reversion short part, because that's where I think is the most potential corporate risk as well. I have the least amount on the trend following shorts that I do with ETFs, because I don't have that corporate risk. So I have 3 trend following strategies on the short side that do just ETFs. But the mean reversion definitely have the bulk, but also the trend following for stocks. I've got a lot of strategies in there. And then there's some other strategies that are super interesting, I think, which are specifically built for unseen scenarios yet. So we want to assume that our future will be different. So we need to come up with some scenario that would negatively impact our trading in a more than comfortable or less than comfortable way. And if you then have strategies for that could deal with that, that could be very, very interesting, I think. Maybe one example for that would be, very often we have seen a little bit of those V-shaped patterns, right? Where market sells off and
quick bounce.
There's basically your trend following long positions get stopped out.
Yep.
Your mean reversion long positions get stopped out. You do not have any open mean reversion short strategies because there wasn't a pullback, and your trend following short strategies are not in there.
Yep.
So then what I have, and that worked out recently very nicely, is a long volatility strategy, which by itself looks terrible, but it's supposed to look terrible.
That's your insurance premium for the
but
the whipsaw, the continuous whipsaw. Yeah,
but it only has the guarantee from me that I will be in when there's a volatility spike to the upside, where I know that my long strategies all are going to be hammered. And then I want to be in, no matter what.
How terrible is its long-term curve, that long vol strategy?
the longer you have it, it will eventually go down to a 90% drawdown or something. But you don't want to look at the equity curve like that at all. You want to look at the spikes. You want to see the big spikes up.
Yep. That's filling your potholes. That's filling your potholes of your portfolio.
Yes, exactly. Yeah. So 2011, 2015, COVID, what is it, 2.5 weeks ago, very nice example as well.
The day we spoke to Tom Basso.
Yeah,
right,
that's
you
right.
were on the podcast with him that exact day, yeah, and that's a typical time period where all your stuff is just going against you, and often your hedges are not completely in or only partly maybe. So what you can do then is having a strategy like that. But the way of judging if that strategy is good, that is the hardest part of it.
And Lawrence, can you explain the long vol strategy a bit more? What are you doing there?
So it's all about the objective first. You need to have the objective, like I want to be in when there is only the slightest possible chance that the market starts to get a spike of volatility to the upside. So it's a very simple trend following component that could be like a 10-day Keltner channel with one average true range. When it's above that, you get in. And you will get out on a 3-day lowest low, for example.
Okay. Short-term
so that
system
means when it continues to go up, you will trail it.
Yes.
You will certainly give up half of the profits, because when that volatility drops again, it drops like a stone, of course. It can go very, very fast. But then I have the assumption that my long systems will making up for it.
It's funny, I had this exact conversation this morning with David Bush, who we've also had on the podcast earlier on, who trades mean reversion. We were talking about hedge strategies, trading the VIX. So could we call this a hedge strategy, and do you execute it, say, on the VIX futures or on, say, the VIXY ETF?
I do it on the VXX. You could certainly do it on the futures as well, and I will once that is automated. I think that those volatility instruments on the ETFs, they have even more of a downward bias. I mean, if you see the charts, they're looking terrible. But because it's automated, I know that I don't need to worry about it. And but the futures would certainly be possible, And you could buy put options as well. I mean, there's no reason why not to do that if people are more skilled in that part as well. It's just that hedging that tail risk. So it is indeed kind of a hedge, But it's like a very sudden move suddenly.
Lawrence, last time we spoke, we talked about your strategy creation process, and you've mentioned the word objectives a lot today. So can we just touch on that? Your strategy creation process, you bring in some interesting points. You've also already talked about, the logical basis for what you do. Last time we spoke, you talked about your lack of trust in statistics, and how you needed to be able to answer objections and answer questions to your strategies. So you talked about black swans and hidden risks, which I think you've mentioned again today, and a couple of other important questions that you ask when you're building a strategy. So can you talk to us a little bit about your strategy creation process?
Sure. It's all about the objective first. The better you have your objective defined, the easier it is actually to find the parameters that you need for that specific strategy. So let me give a clear example of how you start with an objective. Many people, they like to be hedged. It's a very popular thing. So that could be objective number one. When the market starts to go down, I want to be hedged. So then you need to ask yourself, what kind of performance can you get from that, and when do you need that performance? So when does it need to make money? So in this case, the hedge needs to make money when the market goes down. Mm-hmm. Then you can ask yourself, when do I want to be hedged? Do I want to be when the market starts to drop and I immediately want to be in? Or do I want to be hedged only when the market is in the longer term downtrend, for example? Those two questions could be the difference of a parameter that looks for a 20-day look back or a 200-day look back, for example. So you also need to take into consideration the times where you are likely to lose money. Even more important, especially with a hedge. A hedge, definitely on our sample size that we have that is more bullish, you will have most of the times trades that do not work out positively. And you need to accept that. And I always compare that with health insurance. Health insurance is a hedge against our health, basically. We say, okay, we pay on a monthly basis, we pay a premium to the insurance company, and as long as the insurance company is legit, then when we get ill and we need to get surgery, then everything will be paid for. So we are hedged. Mm-hmm. Now, if you want to have top-level healthcare, your premium is higher, but you will be covered with everything. You have no deductible, nothing, but your monthly cost is higher. And it's exactly the same with a hedge or a short selling system that makes money on the downside. If you want to be always to have that opportunity to make money as soon as it goes down, that's possible. Then you look for a very short-term look back of the market that it's trending down, boom, and you're getting in. But the price that you pay for that on a monthly basis is going to be a lot higher when you say, well, I only want to be hedged when the market is below the 200 daily moving average. So now you have a very clear objective. And let's say that you want to be hedged fairly fast. And you can look a little bit in the chart then, say like, okay, more or less when it's like a 30, 40, or 50-day Keltner channel or simple moving average, you want to be in. You want to find an indicator that guarantees you to be in, period. So to me, that would be a very simple indicator. And you don't want to have something that tests better. For example, that you have a downtrend and then you say, I want the RSI to be above 50. Because then you have another variable which could prohibit you from being in the market where you really need it to be. So that would not be in line with the objective. And then once you are in that position, then your only task is to manage that position and stay within that position until you have the proof, basically, that you could get out and that the biggest part of the pain in the market is over. So it's as with if you look for a healthcare insurance, what do you look for? You look for a great payoff with great service and everything, but you look for a low monthly premium. But it needs to make sense. You don't want to optimize things. And that is what happens to a lot of traders. So if somebody presents to me, they say, I've got a hedge over here. and then I see it's got a 5% compounded annual growth rate, and it's got a 5% maximum drawdown, then I say, nah, that's not going to work. Because I know that a hedge just costs money. If I test my hedges from 2007, I will see a 0% compounded annual growth rate or a negative compounded annual growth rate, and between a 40 and a 55% drawdown or so. I prefer to test them on the S&P index, of which I have data all the way back to 1928. That's a lot more fun, because that gives me a lot more feedback of that terrible 1929 crash where the market dropped. And the only thing I want to look at is how much did it make during that time, and was it in all the pain from 1929 to 1932? If I look at the statistics there, you will see a 0% CAGR, or maybe a negative. You'll see a 98% drawdown. But if it made 200% between 1929 and 1932, you'd be very happy, because all your long systems, whether mean reversion or trend following, they'd be terrible.
But the good thing is that's one system of a myriad of more sort of profitable systems that you've got, which aren't seeking that objective. So, yeah.
Yeah,
you're approaching this
you
like
don't care. You don't care if your hedge is losing money, because you're supposed to make money with a lot of other strategies at that time.
You're approaching this like a surgeon, Lawrence, and I'm loving it. Yeah.
You've probably answered the question about statistics being overrated there, because what you're saying is you're looking at other things. The objective is important. So statistics for any, you can't take the same statistic and apply it to every strategy and tick it as good or bad, because they have different objectives.
Yeah, statistics tell you an outcome. Design is a logical development process, a design statement, which, statistics will they're sort of the end stage process that sort of validates your design, but it's your design which is the thing that saves you.
That's the most important thing, because first of all, the statistics are a representation of the past. It's not a complete indication that the future will be the same. At best, it will be a decent indication that something like that could happen in the past. But every statistic that you see, whether it's MAR or Sharp, of every single strategy, in the future, there will be a time where it will be performing worse. So optimizing for Sharp, MAR ratio, whatever it is, I think it's very dangerous. And a good example of that is I think it was 1998, the market crash that was caused by long-term capital management. Yeah. There was a book written about that, when genius failed. And I think that specific hedge funds, they were trading mean reversion, and they were hugely leveraged, but everything was based on statistics, and said we can trade very aggressively as long as it stays within this specific standard deviation. Well, guess what? It got out of that standard deviation, and if it weren't for the wonderful government, they would have blown up the whole system, basically. And it's a classical example where genius relied on statistics 100%, expecting that the future will be equal, and that they're brilliantly built out models, and they for sure know math and statistics 100 times better than I do. But as far as conceptual thinking, I'm not so sure.
Yeah. They could code better than you.
For sure, because I can't.
And it didn't matter. It didn't matter one bit.
Exactly.
You talked in the past, Lawrence, about the questions. There was a couple of key questions that you answer about each strategy, such as when will it make money? When will it lose money?
Yeah.
Mapping these strategies to market. Remind us about that.
So with every strategy, you want to understand Three things, I think. First is, when is it supposed to make money? When is it supposed to lose money? Long-term trend following is supposed to make money when the market goes up, right? When the market is choppy, going down, you're likely to lose money with that. If you run a back test and you've got a phenomenal, beautiful equity curve from left lower to right upper 45-degree angle, and it's long only, you know that something is off. And then you need to accept the fact that your wonderful creation is just one big Frankenstein that will for sure fail in the future. If things look too good to be true, they are.
Probably are.
Yeah, but the other thing is, it's the hidden risk. It's the thing that you don't see in the results of your strategy that could possibly happen. As I mentioned, on let's say you develop a short mean reversion system on all stocks, including biotech stocks, and you've got a volume filter of 50,000 shares. And so my software doesn't have an optimization button, and on purpose it doesn't have that because I think it's incredibly dangerous. But let's say it has. So you just click that optimization button, you go outside, you go drink a beer, and after a day of optimization with a fast computer and everything, you come back and it gives that great return. So what have you just created? You filtered in all the big fat fails as winning trades by finding the perfect pattern. So it looks good in every market circumstances. You say like, well, all the statistics look great. But then starts the part where you need to think conceptually and think about what could go wrong with this strategy. Try to disprove your own strategy. And a technique that I recommend to everybody is, let's say you have created a strategy that you really like. You're very proud of it. It happened once to me before I'll explain what to do. I developed something, it was years ago, like back in 2008 or so. It was one strategy, and I got a 250% compounded annual growth rate and a 5% maximum drawdown.
Whoa.
It's called look-ahead bias, Lawrence.
At that time, I thought I was a genius.
Yeah.
I thought I cracked the code, right? And it didn't took very long until I was very disappointed that there was something wrong with the backtest, of course, and with the software, and indeed a look-ahead bias and everything. But if you have developed a strategy, do the following. Imagine that you are in front of 1,000 very smart but annoying people, and you need to defend your strategy. You need to expect all kind of annoying but smart and intelligent questions. And if you can answer all those questions, then you have a good chance that what you have developed is actually sound. So you need to be super critical to yourself of everything that you develop. How would I be able to explain that to all those annoying people that will ask me all those annoying questions? And probably if you ask yourself then, like, okay, what could those people ask me, which would annoy the heck out of me? There you have your answer already of the weakness of your strategy.
And that takes quite some discipline. I can see where you and Tom have some similarities there in the mindset and the ability to look in on yourself from the observer perspective. You know, you actually need to exercise quite some discipline and slap your ego around the chops to answer those questions.
Yes, but on the other hand, I mean, I think we all have fallen in the beginning for the optimization trap, right? I think every systematic trader in the beginning, you work very hard. That's the hard part sometimes of system development. You can work for 2 years incredibly hard on something, but then you create something that finally makes you very proud because it looks good. You worked hard of it, but that doesn't mean because you worked hard that it's actually good.
No.
So I did learn that over time. Like everything that I create, and I have in my software, I have those 3 things. When is it supposed to make money? I need to write that down. When is it supposed to lose money? But what is the hidden risk? And that hidden risk, I need to be able to define that and understand the possible weaknesses that are not in the sample, because you will get them, period. I mean, before 2020, the whole meme stock thing didn't exist.
That's right. Yeah, it's really, and I've talked about this as my former life in risk management. You have to construct strategies, construct stress tests, scenarios of events that you haven't seen before. I remember, September 11, 2001, we were saying the same thing. Who has ever seen buildings been flown into by 747s, right? So
Yep, exactly.
You need to actually think outside the box to be a good risk manager, and pretty much every risk manager that I saw in the industry wasn't really that good at it. They love to just look at the past, as we do,
Yep.
and model a few scenarios. But I think you actually have to get more creative if you're going to envisage the meme stock blow up or the next disaster. You've got to actually be a little bit more prepared for something you haven't seen before.
Yeah, as much as you can, but then still there will be times where you will have a market movement to which your system will suffer. And I, as a rule of thumb, say if I did a good job on all my tests, I still expect in live trading my maximum drawdown to be double of what my tested drawdown is, without the fact that there's anything wrong with the system. I think that's within the normal range of things. But even if it would be more, you'd need to kind of understand what actually happens. If you don't have in your sample size a crash of 1987, you could expect already a lot larger of a drawdown, of course. And then the question comes, when that happens, are your risk parameters still within your risk tolerance that you won't give up trading? So, I mean, if you get in a 50% drawdown, there's not that many people that will continue to trade. And very often when it happens, it's just due to bad risk management, but not necessarily that there's anything wrong with the system, but you just trade very aggressively. Trend followers, for example, there's that fund from, Paul Mulvaney. So phenomenal returns, great compounded annual growth rate. So he scales in to the upside and adds to the position when it starts to be profitable. I mean, the downside to that is, to my opinion, is that you're going to expect that there will be a time where you're going to have a 70% drop in your account. I personally would not be able to handle that, having the knowledge that I need to make 300% to get back to break even. On the other hand, the turtles did that as well. I know a time where I had a conversation with Curtis Faith, very long time ago, and he said his largest drawdown was 74%, which was the day after the 87 crash, because they changed the interest rates and all their interest rates positions.
To stick with that is phenomenal. How the heck would you stick with a 74% drawdown? Oh,
well, he was an employee. I mean, he just needed to follow the rules. That makes it a lot easier. But if you're a private trader, My goodness. I mean, you'd say, hey, forget about this. I still have got 30% left of what I did. I'm done with this. And yeah, for fund managers, you're going to see like huge swings in assets under management. And to me, it's all about, I mean, when I was young, I had a risk tolerance that was a lot higher than what it is right now. I mean, right now, if I get my 15% compounded annual growth rate and I'm able to get my drawdowns below 10%, I've got a very nice life. It's more the focus of wealth accumulation. It goes from wealth accumulation to wealth preservation, basically. And that makes me sleep very nicely.
Isn't it interesting, Lawrence? We're just talking about long-term capital management. I think before their massive collapse, they had a 2 sharp. And so all of the investors, they would never have seen that hidden risk. They would never have known about that hidden risk. And they'd have comfortably just had this expectation of this lovely linear rising equity curve. At least in the trend following space, I suppose you could say we're honest with our volatility, with a reflection of our equity curves. But there's a lot of strategies out there where the hidden risk that lies within that beautiful equity curve is a time bomb waiting to explode. And for the investor out there, unless they know what's under the hood of those strategies, there's no chance for them if they're jumping on board those type of strategies.
Exactly. They will always be caught with it and exit at the worst possible time where their pain in dollars is unbearable. And I think just having the awareness that even though you've done a very good job with your development of systems, you've thought of a lot of different scenarios, you've got systems that are designed for sideways markets, upward markets, downward markets, black swan events. There's always something coming that will be different that you most likely would not have thought of. Now, the trend followers generally have an edge in there, more so than the mean reversion people. The mean reversion part, when you get those really asymmetrical moves, they're generally in the mean reversion, they're against you. Because a mean reversion system is not supposed to make on a stock 100% in a few days. A trend
steady accumulation of continuous profits and then the occasional big hit, which is the negative skew versus the positive skew of the trend followers.
That's what you can expect. A lot of small different profits, 400 trades per year, and then once in a while you get that drop. The trend following, you guys are hunting for those outliers. That's what you're looking for, basically, and that's why I started as mean reversion only. But that's why I added trend following in there. And I do it 50-50, actually. It's 50% mean reversion for me, 50% trend following.
I've got a half smile there, Lawrence.
Is that smile to Simon?
There we go. You've kept him half happy. We've got to have a little bit of a tip of the hat to Rich.
Yeah, exactly.
This we could keep talking all night. Of course, there's so many interesting aspects to this. But what's an example of, say, what the first year should look like, or first year or two for a newer systematic trader coming in? How can they shortcut as much as possible that learning curve, like setting some right objectives, choosing some right strategies, assessing their own capabilities, what they bring to the table? Like, what are some of the things that need to go on to shortcut that learning curve?
There's quite a lot of things. I think what you first want to be aware of that you shouldn't start trading immediately something until you have something developed that you can validate for yourself. Secondly, you want to trade at a quarter of the size that what you plan to trade with. First of all, because you haven't got the experience yet of the up and down swings of a system. You haven't got the experience yet what your risk tolerance is. Can you handle it when your system goes up and down every day 5% or so? So you do not want to look at the objective of compounded annual growth rate, but you want to look to stay well within your risk tolerance. You want to make it boring. Good trading is boring. My trading is very, very boring. And I like it that way. Secondly, yes, you need to have very clear objectives of what you want to achieve. And you need to find out for yourself, like, do you have more of a tendency of being a trend follower, or is it more of a mean reversion person that you are? Both have ups and downs, and we've spoken a lot about that already, but you want to have very clear or clarity for yourself of what do you want? Are you a patient person or impatient? So if you're very impatient, then a long-term trend following strategy most likely would not fit you at all. So once you have that, you need to have some testing environment. I help people with that, where you can test systems and where you can get the feedback as well. But you always want to have, with every test that you do, you want to make sure that you understand when it's supposed to make money, but when is it likely to lose money. That second part is so incredibly important. Try not to create something that is so amazing on paper, because it won't be that amazing if you trade it live. What else? Yeah, I think risk management is still the most important part by far, but you want to have also somebody up there that looks at you and that will criticize you on everything that you have created for your strategy and say, hey, why do you do this? Why do you do that? Why is this rule in there? And if there's only one question that you cannot answer, then you know that you've just played around with a lot of different parameters or played around with a lot of code and stuff like that. But most likely, it's not a good way. So you want to be very careful before you go live. Eventually, you want to trade live. You need to have that live feedback as well to see what has actually happened. But do that with a quarter of your money, because without exception, I've seen it with every new trader, when they go live, they cannot handle the drawdown what they think they have or that they can stand. They can't.
Laurens, mentorship is obviously very important, particularly for traders coming into the game, to have that degree of oversight, mentorship, or whatever. So you offer mentorship, do you? And can you explain? Yes. Can you explain how you do that and how people can become involved with you?
Yes, absolutely. So they can go to tradingsystems.com. And I offer a 4-month mentoring program, and that is done together with me and my business partner. And it is split up in a couple parts. The first part is a psychological part, where we walk through objectives, your personality, your preference and style, and everything. And that part is done with me one-on-one. Then after that, we move over to the development part. And there's one group call a week with me and another group call a week with my business partner, Alexei. and his group calls are a little bit more technical orientated. So if you want to know the exact math of a standard deviation, don't ask it to me. That's what you can ask to him, because he is way more skilled with that. Mine are a little bit more strategical, because I've got a lot of experience, of course, in putting all those systems together. And you're in a small group of people, and everybody shares their screen, so they get specific tasks on development based on their objectives and what they need in their strategy. And then they show their back-tested returns and everything. And then generally, I am very tough on it. I am that guy of that group of 1,000 people that will ask the student, like, why do you have that RSI in there? And why do you have that number in there? And that is, I think, incredibly important as well, that you get that feedback as well. That is the majority of the mentoring. There's a position sizing part at the end of that, and then there's a part where we help you to go live. And the software that I personally use is included in the mentoring program. It's not a retail software. It's not for sale for retail clients. It's only within the mentoring. And just go to tradingsystems.com. There's a link there that says Elite Mentoring. And then you can apply for the mentoring, and we can get on a call and see if we're a good fit to be working together.
Okay.
Cool. Lauren, so we have covered so much good stuff across so many quadrants of trading, diversification of markets.
Feels like we just gotten started.
Yeah, we just started anyway. Yeah.
Well, we can always do another one, but yeah, we've talked about diversification of markets and strategies and mean reversion to trend following, rotational, hybrid strategies, risk management, mindset, psychology, logic, building things up from a logical based approach, risk management, the questions that you need to ask, things that you need to check. I mean, this podcast is a mentorship. This is
a great one.
All wrapped into one. And
I like that, yes.
It's brilliant. And it really just testifies to how, I guess, I think to be a good trader, you do need to be a bit of a generalist, a bit of a jack of all trades. And that's why it doesn't necessarily suit the expert in who, as we talked about, say, is just a coder or a genius that can produce a Sharp of 2 and for a long-term capital management.
I agree.
There's a lot of factors going on. It's a commercial and entrepreneurial mindset. There's a state of analysis, and there's a discipline, and there's a humility. All of these things that we can all be working on, and they all add up. We're trying to solve this problem. We talked about 2022 and trying to solve things. And so, it takes that kind of person who wants to analyze things and work things out and, wants to win, wants to actually master it at the end of the day. Yeah, so we've probably scared a lot of people off trading. They just gave up on the spot. But if that all appeals to you, it's fantastic.
We've given them realistic expectations.
Exactly. It's good to be clear of what real successful trading is. It is top sport at its highest level, and
athletic.
It's very hard, and it's the irony is it's the easiest profession to get started with. I mean, you open your brokerage account, and your broker even gives you some videos that you can take a look at, and then you can buy stocks and stuff like that. But it requires for everybody a lot of work to really get to the point where you have something that is going to be profitable. But it's a phenomenal journey, and I love it every day. And I love a podcast like this as well, where I've got two very bright gentlemen who really I can have a nice conversation with, because when I walk outside of my office over here, to my friends, I can't talk about this stuff. I mean, they're like, what? They're like all buy and hold and stuff like that. And they kind of were a little bit impressed about my books, but when they started reading it, they were like, nah. So we're like a small group of people.
Obsessed people.
Exactly, but that makes it actually good as well. It's totally fine to that it stays small.
Yeah, and that's why we started the podcast, so that we could talk to other obsessed people. Right. But, when you talked about open, it's so easy to get started. And, of course, what people forget is it's so easy to place a trade, especially today on the phone. But, of course, the moment you do that, you're actually competing with the most elite, the best of the best, the PhDs, the Goldman Sachs, the professional quant, whatever it might. You're just straight in the ring. There's no training ground. There's no, B grade.
You come in with your white belt and you find you're up against 12th Dan black belt,
Yes. And sometimes they toy with you for a while.
There's one edge that we have against the Goldman Sachs people and stuff like that.
Yes.
Besides the fact that I think as far as risk management, banks are not necessarily that good. The evidence is there. But the other thing is our trading universe, liquidity. I mean, people who are trading $1 billion, they cannot trade a big part of the universe of mean reversion stocks that we trade. Or if you're a trend follower on commodities and you want to trade in lumber and orange juice and stuff like that, the big boys cannot do that. So that at least is something where we have a little 100%. bit of an edge, I think.
Yeah, no, agree. And we should exploit that while we can.
Absolutely.
Until we're trading $1 billion, which probably will be soon enough.
Oh, yeah. I mean, it's just doing the math.
Lawrence, no one's been able to talk you into starting a fund or trading other people's money?
I've done it, and Tom Basso talked me out of it.
Yeah,
right. I started it back in, what was it, 2013 or so, and I sent Tom Basso then a Facebook message. We were connected on Facebook, and I said, hey, could we have a chat? I'm starting a fund and everything, and we had a nice chat. Everything was very nice, and he gave some good advice. And I then, about a year after that, I met him in person. I first had a meeting with Eric Crittenden from Standpoint Alternative Investments, which I'm a shareholder of. And at that time, Eric, I mean, he's like brilliant, and I needed some advice.
I want to get him on the show, actually.
You better. He's excellent, really good. So, but Tom was living close by. So the day after, I had dinner with Tom, and he kind of talked me out of it, explaining all the issues that he didn't like about running a fund. That it looked like you needed to deal a lot with accountants, with lawyers and stuff like that. And I'm not a corporate guy. I never was in the corporate world. And when I heard that, I was like, nah, that's not like me. So I did it a little bit. I managed maybe up to $40 million or so. But what I didn't like either was it was a multi-strategy fund. But I didn't like those freaking phone calls when the system is down 3% and the market is up 2%. Yeah. And then I needed to answer that, although the system was exactly doing what it was supposed to be doing. So I think for a fund manager, you need to be able to really be comfortable to deal with all the bureaucratic stuff. And if you want to have a hedge fund, the starting capital is significant, especially in the US. But then the other part is dealing with investors and stuff like that. I mean, it would get me into, if I wanted to be very successful, I think the strategy is only maybe 10 or 20%. The rest is raising money and raising capital and stuff like that. And there's enough examples of funds that have returned negative performance over a long period of time that have billions under management. And so you're competing against a world that I'm not in, but that I don't like either. I don't like to get phone calls at 8 o'clock in the evening explaining about a strategy. No, I'm done at that time. So exactly. it's the research part for a fund. That's fun. That's really nice. But anything else, it would really get me into a 60 hours a week job. And then it is the question, does that extra amount of money really, is it worth it? Yes or no? And I always do an exercise very often to myself. I look at myself as if I were 80 years old and I'm looking back at my life. And then I ask myself the questions, did I do the right things? Did I have joy in my life? Did I have fun in my life? Did I love? Did I spend enough time with my children? Did I have fun with my friends? And of course, the money aspect is important as well, that you want to be financially free and stuff like that. But if you have $10 million or you've got $1 billion, to me, the price of that would mean to sacrifice the amount of time I could spend with my children, the amount of time I could spend with my partner and with my friends and stuff like that. To me, that's not worth it. So I use that very often. And some people say, well, this is what I really like. I like to be the best fund manager there is. If that is your life mission, go for it. Absolutely. To me, it's not.
Tom Basso probably didn't become Mr. Serenity until after he stopped trading other people's money.
I think that certainly helped, but Tom was from very young on. He was very into psychology already. I mean, he was 12 years old when he read a book that was called How to Meditate Yourself to Sleep.
Wow, yeah, he said he's good at that. Wow, amazing.
His wife says that within 6 seconds he's asleep, basically.
I've got to read that book.
Yeah, it's not, we don't know where it is. We can't find it anywhere. Once in a while we do host a seminar together, and Tom teaches that technique to the attendants, which is a lot of fun. But he's got a very interesting and very, very solid mental state. And there's a reason why Jack Schwager called him Mr. Serenity, but also a reason why I wanted to get to know him and model my mental state of him. I was never that interested in his strategies because I've got a different view on strategies.
He didn't mean that, Tom.
The mental state part. Oh, he knows that. I mean, we're very open about that.
Well, Tom did mention possibly doing a cruise down to Australia. So, we might have to get you down here and have our own little conference down under. That would be amazing. Hey, Lawrence, we need to wrap it up. We've been talking for 2 hours. Would you believe it's gone that quick?
I was expecting it, actually. I mean, on our prep talk before...
we knew it was going to be a good one.
It was like an hour and 20 minutes already. So I said, okay, this is going to take a long while, but incredibly pleasant. It's
thank you.
Really nice talking to you guys.
Oh, it's been fantastic.
Been a real pleasure. I think this is such an informative show, and people are going to absolutely love it. So we'll have to get you back again sometime, Lawrence, and hopefully get you down to Australia.
I would love to, absolutely.
We should remind you that the conversations on this show are informal and for entertainment purposes only. Certainly any general advice you may hear is obviously not specific to your needs, goals, or objectives, so nothing discussed on the show should be considered as investment advice. If you want that, you'll need to actually do your own research and speak with your financial advisor. Remember, trading can be extremely risky and past performance is not necessarily indicative of future returns. If you enjoyed the show, please subscribe or leave us a review, and if you have any questions or feedback, we'd love to hear from you. Bye for now.